You're 67 years old, you're still working, and you've accumulated $1.2 million in your 401k. But you're asking yourself a very important question. Is now a good time to convert this money from the 401k into a Roth? That's what we're going to look at with our time today. Welcome to our time here. My name is John Vandergriff. I'm one of the owners and wealth planning team lead at Blue Ridge Wealth Planners, where we help people transition effectively into retirement, or if they're already enjoying their retirement, build plans to solve for the things that affect you financially in this retirement phase of life that you're in. So one of those things that is a very important conversation that we have on a daily basis is in the realm of taxes and tax planning. And we're going to dig into that because one of those main topics that we look at is, should we convert money to a Roth? So this particular situation, I'm 67, still working, $1.2 million in a 401k. Is now a good time to convert to a Roth? And so again, we're going to dig into this a little bit deeper. Two things I always like to start with. If you enjoy these videos, make sure that you like, comment below, share, subscribe it to other people, just so that we can get that feedback, but also help more people learn about the type of tax planning strategies that are out there. But in that realm, do not act on just the information that you see here today, because we're looking at a very specific example. We work hand in hand with our clients and their tax professionals to make sure that we have all the information that we can before we make any moves to do a Roth conversion or recommend a Roth conversion. So with that being said, I want to dig in. And again, for us at Blue Ridge Wealth Planners, we help people build what we call a plan for everything that looks at the 5 areas that you need to plan for in your retirement life: how you generate income, invest your money, taxes and how you pay those, healthcare, and then family legacy. And what you're going to see, even though we're really going to focus today on taxes and income, it's how much overlap there is in all these areas and how much planning needs to be done, but also considered in the decisions that you make in each category. So as we look at this situation, we've got a married couple, age 67 and 65. Their plan is to work another 3 years at $100,000 of income, plus any inflationary increase. And then what we've got here is $1.2 million that they've been able to accumulate inside of 401k accounts, and then an additional $200,000 in bank type positions or after-tax savings and investment accounts. Now, when they get to retirement, their combined Social Security will be roughly $6,200, and their income need at retirement is the same as their income today, $100,000 a year, that they want to just continue and enjoy, and obviously adjust that for inflation as time goes by. So as we look at this, when we think about Roth conversions, here are 3 simple things that we need to factor in when we're considering this movement. Is obviously any dollars that come out of an IRA or a 401k will be considered a taxable event, and they are actually taxed on top of any other income that you have. So going back to our example here, this couple's making $100,000 a year, so a dollar comes out of their 401k, it will be taxed on top of the $100,000 of income they have at their top tax rate, and then up from there as they take it out. So we need to know that, and that counts whether you do a conversion or just a distribution to yourself. It is a taxable event. If we do a Roth needs to be in place for 5 years before you get completely tax-free distributions out of that account. So whether it's contributions, conversions, growth, after 5 years of being open, doesn't matter what it is, it's available for you tax-free. And then if you start conversions over the age of 59 and a half, the principal that you convert is actually available to you within that 5-year window with no penalty. You just can't take any growth out on that principal during that 5 years. So as we look at it, these are important to consider when we look at Roth conversions. And so, not jumping ahead too much, if we start to plan some details into this particular situation, we've got today $100,000 of income that these people have in their wages. They need $100,000 in their retirement years. $6,200 of it will be coming from Social Security. So that means they'll have about $75,000 of income taken care of already. But if we're looking at Roth conversions, we've got to pay attention to where that income need is today. Or where that income is and where that tax rate is. So $100,000 of income would be a 12% tax rate. Obviously what's affected by that most is the money that they have in these pre-tax accounts. IRAs, 401ks fall into that category. $1.2 million, and then $200,000 in after-tax, currently no tax-free positions in either Roth IRAs or properly structured life insurance plans. So if they're wanting to start moving into more tax-advantaged positions, it's going to cost them, from a tax perspective, at least 12%, and then up from there, depending on how many dollars they do. So as we look at 2023's tax brackets with a standard deduction, and again, married couple here, their top dollar today is in the 12%, like we just saw. That maxes out at $117,000. If we compare that to some tax time frames that we need to consider. So the first one here is looking at the year 2017, and the reason that this is a relevant time is because the current tax code that we have, if it expires, it will go back to the way tax brackets were in 2017. So as we look at this, that $100,000 of income would be taxed at 15%, but only $400 would be taxed at 15%, and then it would jump into the 25% tax bracket. So again, any inflationary increase on the income they would have almost would certainly bring their top dollar to 25%. And then if we compare this to a different time frame, not saying this is where we're going to, but just to look at something that we know has happened and we could return back to this, a time where our top tax rate, instead of being 37% like it is today, was 70%. That was in 1981. $100,000 adjusted for inflation today would have put them into the 32% starting tax bracket. So again, noticeable bump from 12% that they are in today. So as we look at this, the reason we're showing taxes increasing here is because of what's happening around us. So because of overspending that's happening in our government, but also the debt that they've accrued over many years of overspending to the tune of over $30 trillion, to solve both of those problems, the way to do it is to either decrease spending or increase the amount of revenue that the government gets. The way they get paid, tax increase or tax revenue. So taxes would have to go up to increase that bucket. I think that's a very high likelihood, and I don't think it's just going to affect the ultra wealthy. I think it's going to affect most all of us, especially when we look backwards and see where tax rates have been in the past. So as we look at this, if we are trying to consider to do a Roth conversion or not, we want to look at the time that we can pay the lowest percentage tax possible. That's what we are after. So as we look at this, for round number's sake, let's say we're looking at $100,000 in a 401k. We've got to ask ourselves a question: does it make sense to leave this money alone or to move this into a Roth account and see which one gives us the best benefit at the end of the day? So again, if we leave $100 in its account as it is now, it will have no taxes paid today, will continue to grow tax deferred and be worth $100,000. If we move that money to a Roth, you'll have $100,000 that adds on top of, in this case, $100,000 of income, and then you would pay taxes based on whatever your tax rate is. And so let's just say for this example, it's 20% effective tax rate. So you would have, if we pay the taxes out of this money, $80,000 that you can use in this Roth. You've paid the taxes, now it's able to grow tax-free, but most advisors will actually stop you at this step and they'll say, you don't want to do this because if the market goes up after you do this conversion, you're going to make less money. Because if the market makes, let's say 10%, this side will make $8,000, this side will make $10,000. So short term, 100% correct, you will mathematically have more money in this bucket than you will over here, but we're not looking at equivalent buckets. This bucket is fully taxable, this bucket is tax-free. So we've got to go down the line enough to make these apples for apples comparisons. So to do that, let's say we invest it in the same thing for the same length of time. And again, assuming it's longer than 5 years, so our Roth account is able to have tax-free fully benefits. So it's worth $160,000. The doubling of the 401k brings this side to $200,000. The financial advisor is looking at this saying, yep, I made a good decision here, telling them not to do the Roth conversion until you go to take the money out. Now the Roth account, we know, since we're past the 5-year part, we've got all of this money available to us tax-free So you know you've got $160,000 that you can get to. The 401k, it depends on what the taxes are at the time you take it out. And so what's interesting is if that tax bracket is the exact same and it's 20%, you will notice that the bottom line here is the exact same as the Roth account. You say, why? Well, you notice the tax percentage at the end is the same as the tax percentage at the beginning. So what we've got to determine for you as an individual is when is the best time or the time where you can pay the lowest percentage of taxes. Not have the lowest income, the lowest percentage of taxes owed on that money that's generating income. Because the way that we typically hear the advice for retirement planning when it comes to taxes and savings is we need to wait until later to pay our taxes, because in retirement we'll have lower income. Lower income means lower taxes. The problem is no one has ever promised you that. We just assume that that's the way it is, but as we look back, we notice that there are times where, for this couple, if they had $100,000, or let's say they had less, let's say they were at $72,000 of income, they would still be taxed at double what that tax rate is today on $100,000 of income. So that's not something that's always true, but if we assume that it is, and let's say your taxes did go down in your retirement years, you would actually have a better situation at the end of the day if you did not touch the 401k, because you'd have more money. Even though this side has been growing tax-free the whole time, you paid a higher premium to get in than what it would have cost you later. So if you can pay lower taxes later than you can now, don't do a Roth conversion. But as we said, with the risks that are happening today with the overspending in Washington, I almost think most of the cases that we see are going to experience a higher tax in the future, even with equivalent income. And so for this particular situation, if they were at $100,000 of income, there's a very high chance that they could pay a higher percentage of taxes on that income than they do right now. And if that's the case, then as you see here, your bottom line ends up with more money by doing that Roth pool today. So as we look at this, and sometimes people will say, oh, well, if they take little chunks of money out later, that'll be better than taking big chunks of money out today. Well, it doesn't matter if you take $2 out of this or $200,000. If the tax rate is the same based on what it's taxed on top of, it's just the percentage that's owed. So you could take $4,000 out at 30% tax, and it'd be worse for you for the dollars that you're taking out than if you made that move today. So hopefully that makes sense. And so as we compare this to this actual situation we're looking at, we see that at $100,000 of income today, their starting distribution out of their 401k, even though they're still working, would be taxed at 12% starting and then up from there. If they waited and the tax code expired and went back to the way things were in 2017, they'd have about $400 that would be taxed at 15%, but mainly 25% would be where we pay attention to. And then the starting distribution, if things went back to the way they were in 1981, would be 2.5 times whatever we're looking at right here. So again, I think reality is probably somewhere between these two brackets. But as you see, both cases are way higher than where that tax rate is now, which means it would make sense to start this journey. So then the question becomes, well, how much should we convert? And so as we look at the different brackets, and hopefully you understand that as you pay taxes, you progress through the brackets. But if they've got $100,000 of income today, they'd have a little over $17,000 that they could convert at 12%. Then they would have another $101,000 that they convert at 22. And if they were trying to max out their conversions and get as much as they could get converted underneath the 25% tax bracket that we just looked at here, then they could go up to the top of the 24, and that would give them $291,000 that they could convert at an effective tax rate of a little over 22%. So as we look at this, that's something that we've got to pay attention to when we sit down with people is, if now is the right time, how much can we effectively do? Not trying to do the whole thing and jump taxes up way higher than makes sense, but how much can we do based on the information we know, and also making sure that we think we're going to get a pretty good deal, keeping as much of this money as you can. So obviously this is important to consider, but we also need to pay attention to, since this couple is age 67 and 65, we have to recognize that anytime we increase our income above certain levels, it will have an effect on the Medicare costs that you pay, which is going to be something that will come out of your pocket or really your Social Security check. So once your income gets above, this year, $194,000, your baseline cost for Medicare, which is $165 per person per month, would go up depending on how much you increase that income to. So obviously, the first one here is about $1,600 for that year, and then you see the overall cumulative increase, so it could get fairly pricey here. The way you've got to approach this is not saying, oh, if it's going to cost me something, I don't want to do it. No, you just got to add this to whatever your federal tax income is, and see if it's still a good deal for you to convert. Because again, this plus the taxes is what the cost of conversion is for this particular situation. We've got to know that before we pull the trigger and not be surprised afterwards. So again, just because we're paying an additional cost, that doesn't mean that the conversion shouldn't happen. We just need to know that before we make that take place and maybe not understand it and have to pay something that we didn't understand. Because they're going to base this on what your income was 2 years prior. So if you're 65 this year, they're going to look at your age 63 income, and that's going to be what they determine your Medicare premiums for that first year, and then they're going to continue to do a 2-year look back every year that you progress. So as we look at this, things like the Medicare cost, and also the complexities of taxes are why I think it makes sense to talk to someone. If you don't have someone that has helped you in this world of tax planning, or the conversations that you've had have not gone deeper than where we've gone here in roughly 15 minutes, I would invite you to come and talk to us. You're going to see a link pop up below. I would ask you to click that link, schedule time where you can talk to one of our wealth planners and see how we can help you decipher all this information to see if now is the best time for you to be able to pay those tax dollars, or the most efficient time for you to be able to get the most money to stay with you. Because again, it's all about what percentage we pay now versus what it will be later. But again, everybody's situation is different, and so we've got to be able to sit down with you to give you that advice. So hopefully you enjoyed our content today. Make sure, as we said, to like, share, subscribe this video as you see those options below, and we look forward to providing more information to you in the future. But as far as we have for today, that's all we've got, so we look forward to seeing you next time.